This program is sponsored by Wilsey Asset Management.
Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I am Brent Wilsey, and thank you for tuning in this morning. I started the Smart Investing Show about 28 years ago when we discussed finance, investing, and the economy. It is a call-in show, and if you would like to hear, we would like to hear from you. We'd like to hear what you have to say, give you that unbiased, no strings attached, trying to help you through the investment world here and make you a smarter investor. You can give us a call here at the show, 866-577-2473. That's 866-577-2473. But before we take the calls, we want some big topics to talk about. With that, help me out is Chase. Good morning, Chase. How you doing this morning?
Good morning. Doing well.
Well, we got to say we're a little bit tired this morning because we went to the great Padre game last night, and wow, what a game. I mean, gosh, I've never seen somebody hit three home runs in one game, and all the home runs. Like, wow, it was like almost like a football game with a score.
Like a home run derby.
Yeah, it was great. So it's kind of nice to be there. But we're a little bit slow this morning because the game went kind of late. But
I know we're not a sports talk show, but I will have to say it was against the Diamondbacks, who I think have lost like 23 road games in a row. So
yeah.
They did sweep the Dodgers, which is good. So
yes, exactly.
But it was a lot of fun. But yeah, you're right. I'm tired. So.
So people, please go a little bit easy on us. Talk slowly for us so that we can comprehend. But let's talk about some important things happened last week, and let's talk about big tech companies. One of my major concerns the last few years has been the regulation. And with Biden's recent nominee for the Federal Trade Commission, the FTC Commissioner Linda Khan.
I don't know if it's Lina or Lena, but there's no D's.
There's
Linda
no D.
without a
You know
D.
what? See, here we go already. This part, I'm already putting D's where there's no D there. So it's Lina Khan, getting confirmed in the Senate. I almost say getting confused in the Senate. Great. Confirmed in the Senate. And those concerns, they'll go even higher because, Khan wrote the now famous article, Amazon's Antitrust Paradox, while she was a law student at Yale. And she is not, I don't want to say she's not pro-business, but, there's some things here that kind of worry us. And nothing grows forever. And I think she's somebody that's going to have some concerns here and do some things not tomorrow, but long term.
I'm not going to say she's anti-business, but she's definitely pro-regulation is the way
there we
I
go.
would
That's
put
a good
it.
way to say it. That's a good way to say it.
But, the article she wrote while she was a law student at Yale, that Amazon's antitrust paradox, she really criticized Amazon and its practices. And, if you really look at it, it's actually kind of like a blueprint for regulating that big tech. And she also compared the group of tech companies, and kind of heard this before, called them monopolies, and compared those monopolies to like the oil barons. And we know oil got regulated. She compared them to the railroad tycoons. And we know that, back in the earlier days, that's where a lot of people made money. And they came in and they actually did regulate those two industries quite heavily. So is this going to be something that's going to now occur with tech? And, those two areas that I mentioned, they really did see some severe regulation after excess growth.
Right.
And we've seen now excess growth in technology. So kind of, I was reading an interesting article and it said, history doesn't repeat itself, but it rhymes.
Yeah, very, very good, yeah.
And
I was going to use that later in the show, by the way. But I'll do it again.
But the other thing to look at, too, she also co-wrote a paper with outgoing FTC Commissioner Rohit Chopra, arguing that FTC regulation has relied too much on litigation rather than issuing new rules. So that is kind of concerning as well because rather than just suing the big companies, she wants to say, I want to create rules perhaps so you can't do these things, and I won't sue you now because, now I'll just have the rules instead, which means I'll have to follow it.
When I first looked at this, it's kind of confusing because, wait a minute. Creating new rules, it means you're going to be suing them anyways. But I think you have to, first of all, establish good, strong rules to create the case. So that's what we're saying. It's not going to happen next month, but this is something that's going to happen over time because now you're going to put the rules in, and then if they break those rules, now we've got you, and then it's a clear way they're going to be able to sue them.
Yeah, so it's kind of a shift, and it's interesting to see is this going to be how she's going to be running the FTC? And if they do have kind of a majority on that side, I think there's 5 people in the FTC that they could get some things through pretty easily. It's not like the House and the Senate where, the Senate you have 100 people. You got to get that through. Well, now there's just 5 people that you have to convince to kind of get these things through. So,
and it's just surprising as well that the ease, which it got confirmed by the Senate. I mean, gosh, the group voted 69 to 28 in favor of her approval. I mean, that's overwhelming approval. So it's not like people, and we do talk about that. There's no one really on the side of the big tech because Republicans who are big business people, well, they don't really like them. The Democrats are more smaller business, more regulating the business. So there's nobody really on the side of big tech, and it's going to be an issue for these big tech companies, and that could be the fall of them to where they go from a 30, 40 times PE down to maybe a 10 times PE.
Yeah, I mean, people don't understand how burdensome regulation is and how it can really stifle growth. And you take away the growth from these big tech companies, and it might not even be that they stop growing, but they start growing at a slower rate. That's what could really be their demise, because you're right. They trade at 30, 40 times earnings because they're growing at 20% a year. Well, now all of a sudden you're growing at, let's say, 8% a year. You don't trade at a 30, 40 times multiple.
Right.
So that's something to really be, I'd say, leery of. And, just be cautious here, because we know that this has actually been a bipartisan issue for years. Yeah. And it was funny. I was watching, Fox Business earlier this week, and there's a gentleman on there talking about big tech regulation. He's like, I'm not worried. It takes years for this stuff to kind of happen. And this big tech regulation has actually been a bipartisan issue now for years.
Yes.
It's not like,
this
is something new.
Yeah.
So it has been going on, and we've talked about it now for years. And I do worry about this now kind of starting to maybe push the pace with the new FTC commissioner.
Yeah. And things do change, and you're so right, though, because people think, it's new. It may be new because we're talking about it, people are talking about it more, but it's actually been building for years. So we're maybe, in the 5th or 6th inning of the game here, to where you're not starting the first inning. You're in midway through the stage here. So that could be a big change. And again, I mean, I love watching history, and I remember watching about the railroads in the early 1900s, the oil companies, the Rockefellers and stuff, what went through with that. It does eventually become regulated, and they'll be broken up. They'll be much smaller, and I don't think they get that growth rate that they have.
So, I mean, you look at Amazon. You break up Amazon, a lot of times the way that they do the retail business, it's not super profitable.
No.
They make their money on the AWS, so it can almost kind of subsidize other parts of the company. So people say, Amazon's worth more. If you look at the kind of sum of the parts, which means you break them apart, they'd be worth more. And I don't see the math on that, because I don't understand how you can look at the retail part and be like, wow, that is a phenomenal business by itself, and it's phenomenal for consumers. Mm-hmm. But in terms of profit margins, I'm not sure how profitable that is. I know it's not nearly as profitable as the AWS.
And actually, sometimes the government, by trying to break down smaller businesses, actually can hurt the consumer, because you brought up Amazon retail. It's great for the consumer, but it's subsidized by the businesses. If they're forced to break up, Amazon won't have that benefit, and that retail of Amazon, who knows what the new company will be, will maybe have to raise prices or do something else, because they can't afford to do it strictly on its own.
Yeah, no, and I do look at these companies, and I think it's great that they have. I mean, a lot of them have very high profit margins, which we like to see when we invest in businesses. Yeah. But the problem is they're almost too high. Where I'm going to say a lot of people that are, again, pro-regulation, kind of looking at creating a fairer landscape, so to speak, not in favor of these monopolies. They say, well, that's not fair. You shouldn't be making that much money. So, I mean, it's kind of almost, they're making too much money. They need to pull back because they're in the crosshairs here.
Yeah, it's true. Well, let's move on. I mean, because, a lot of people are concerned about electric cars and, oil is going to be a thing of the past. Well, have you ever looked into where a barrel of oil goes? I mean, you got one barrel and people think, it all goes to gasoline. That is not quite the case. The real answer is only 46% of a barrel of oil goes to gasoline. The remaining 54% is broken up in different ways there.
Yeah, and the way you look at it is actually 32% goes to diesel and heating oil. So that's kind of surprising. That's a large portion of it.
And you know what's funny, Chase, too, that just popped in my head, is that heating by electricity is very, very inefficient.
Yeah.
So that won't be changing.
Yeah, I didn't know that when the gas actually is how you heat your house.
Right.
And because I remember I was heating the house and I was like, whoa, that was a couple years ago now. I was like, whoa, I didn't know my gas bill was gonna go way up. And it's like, oh, it's from heating. So you're right. I don't see that changing anytime soon. Other things to look at, too, is 14% of it goes to petrochemicals and 7% of it to jet fuel. And we've talked about this before. I will not be willing to get on an electric plane for probably 30 years. I just said, because batteries are a lot heavier than.
And also that, I mean, if you, for some reason, don't charge or something happens with it in a car, while you pull over and you call Tesla, whoever it may be, to come charge your car for you. But in the plane, you're going to crash.
Yeah.
And it's just the fuel is much more dependent right now. And again, you're right. 30 years down the road, who knows what technology will bring us. But right now, it's not the time to say, oh, just sell out of oil because next year everybody's going to be driving electric cars. You don't need oil anymore. That is not the case.
Well, it's funny, too. You talk about electric cars. It's like, oh, wow, you can go 300 miles on a charge now. Oh, sorry, can't fly to Europe because we're going to crash in the middle of the ocean because we don't have enough electricity to get there. I mean, I know it's kind of a funny way to think about it, but they can probably put more on the planes,
right.
But then you have to balance out the weight and so forth. And the other thing, too, that's interesting about the discussion around oil is if you completely remove the electric cars and it's like, oh, well, we're good. Well, now you have kind of a different type of market where I think it could send oil prices higher
right.
as we're balancing that out.
Right.
Well, if oil prices go way up, talk about now heating your house. Oh, geez. Now that's going to be, instead of, let's say, $50 for the month, now it's probably going to be $80 for the month.
Right.
You look at flying on the planes. Well, the planes aren't going to be like, oh, well, that sucks. We have all this higher cost now in jet fuel. Well, we'll just eat that. No, they'll raise ticket prices. So now it's more expensive to fly. So it's something that, I think I'm going to say it's a fantasy to think that, oh, we don't need oil. We can get rid of oil. It's not a reality.
And it's funny. I was talking to a good friend of mine from the Army, Reggie, yesterday driving home. I just called him up and, hey, Reggie, how you doing? But we were talking about electric cars. And he goes, I'll never buy an electric car. And we know that they're going to stop making gas cars coming up maybe 10 years, 15 years from now. But even then, it's just like we're still going to buy the older cars. Same thing, I'll never drive or buy an electric car. And it's not just Reggie and I. There's many people in that same thing. So you're still going to be having the use of gas for many, many years, use of oil for many, many years. And again, don't forget all the uses that we've talked about in past shows about what oil is actually used in.
Yeah.
So. Well, let's talk about things we've talked about here in the past. And we've done this quite a bit, but we talked about the discrepancy between the unemployed and the job openings. But one element that isn't discussed as frequently is, are people now able to retire from the labor force? With the stock market and real estate market hitting all-time highs here, I mean, baby boomers may be able to retire when pairing their appreciated assets with pensions and Social Securities. I mean, the baby boomer generation, which I'm part of, was born between 1946 and 1964, which means the tail end of the generation is approaching their retirement years. And this is a big thing that people need to look at. I do believe we're going to have a labor shortage coming up.
Yeah.
If we don't already, I mean, what am I talking about?
I was say, coming up, we have one.
Sustained labor shortage.
But, yeah, I mean, in fact, you look at the numbers here, which we always like to do. In the third quarter last year, 28.6 million baby boomers reported being retired. This was a 3.2 million person climb from the third quarter of 2019. Compare that to 2019's growth from 2018 to 2019. That saw 1.5 million people retire. So we more than doubled last year what happened between 2018 and 2019. And now you look at the share of retired boomers, that has now hit 40%. I mean, that's only going to climb.
Oh, yeah.
As time progresses. So it's definitely something to watch. And don't forget the boomers. They're a huge part of our population. And as of recent data, they accounted for 69.56 million people.
It's a pretty big number, but it has actually changed a little bit because you dig a little bit deeper. What this means that those in Generation Z, I get all these generations mixed up with Z, will now need to start replacing those boomers in the workforce. Those in Gen Z were born from 1997 to 2012, and they account for 67.2 million people.
Yeah,
And you know what? And that's going to change. I hate to say this, but the baby boomers will start passing away.
Yeah.
So I think pretty soon the Gen Z is going to be the big generation.
Yeah, well, millennials are actually probably going to maintain that lead for a long time. Because,
You're in the millennials, right?
I mean, millennials are now the largest group as they stand at a population of 72.1 million people. And the reason I say that Gen Z is going to actually have to start taking those jobs as baby boomers leave the workforce is because the millennials are already in their mid to late 20s. So they should already be in the workforce. So that's, and it's kind of funny. We did a little tease on social media yesterday about what we're going to be talking about today, and I said, are baby boomers to blame for the labor shortage? And I'm sure people are like, what is this guy talking about? You know? And we were just saying because, you know, baby boomers are coming to that age now where they can retire. And I just am very curious to see what happens in, you know, the labor force participation rate.
Mm-hmm.
I mean, are there going to be more boomers that are like, you know, it's not worth it. Like, I have my pension. And that's one thing, too. A lot of baby boomers, they still have pensions.
Right.
Millennials, we don't know what pensions really are because not many companies offer them anymore.
Yeah.
So it's something that's very interesting is, are those boomers now just going to say, yeah, I'm good. I don't need to come back to the workforce. COVID kind of forced me to retire, and I'm in a good enough spot where I can. I'll collect my Social Security. And that's the other thing is more of them start to hit that Social Security age. It's like, yeah, I'm good.
Yeah. And the thing is, things are changing with each generation, which is something that worries me because, like your generation, I guess the Gen Z generation, they've not really seen. I mean, because 9/11 was what now 20 years ago. I mean, you were what 7 years old back then. You really don't remember it. It hasn't really affected you, and this is what worries me. And I bring this up because I saw this on Thursday in the Wall Street Journal. That there's a newspaper that's been in Hong Kong for 26 years. 26 years. And Beijing shut it down.
Yeah.
This is the things that kind of worry me because I'm very concerned about China going forward. And when I talk to some younger people, like, oh, no, you're an old warrior. Don't worry about it. They don't realize, and you mentioned earlier, this was going to use it, about it may not repeat but rhyme. This is what happened with Germany and Hitler, where he started and people, oh, it's okay, until it got so big. And this is what worries me with China is that they're taking it slowly and taking these things away. And when we look at what we need to do here, I'm not going to tell you how to vote, but I think you should be looking for people to vote for that are concerned about the growth of China. Because if it goes too far out of hand, all these freedoms we have, they will be gone. And again, it does affect investing because it's going to change that as well. But it just worries me that, you know, for your kids and so forth, they could grow up with a whole different thing here. And
I'm going to kind of say not to worry about the growth of China, but how they're growing.
Yes. Yeah.
You know, because if they're growing in a good fashion, you know, they got businesses coming in, doing that, good for them. But the way they're doing it, yeah, I mean, and it's so, I'm going to say funny, is looking back at last year or 2 years ago, I think it was, when Hong Kong was having those riots and stuff because they started taking things away. And you're so right. It's a progression where it's like they're not just going to go in there and take over Hong Kong in a single day.
Yeah.
They're not going to do that because they know that the world will look down on that. But, yeah, we'll take away your newspaper. We'll take away this one bill. We'll do this. We'll do that. And all of a sudden, 20 years from now, Hong Kong is no longer the independent they're not a country. It's like, I forget the terminology that they use to separate Hong
Territory?
Kong.
Territory?
It might be a territory, but they're supposed to be independent from China's rule. They're supposed to have their own kind of freedoms that people don't have in China. But taking away the press, I mean, sometimes I don't always agree with the press says here in our country, but you have the right to the press. And to take that away, I mean, that is what gets really dangerous because the government controls it.
Yeah, they control, and that's what we talk about. And again, most people say, oh, it's just Hong Kong, just a little thing. But that's where it kind of starts. And again, China already, what do they have, 600, 700 million? No, billion people, right? How many do they have there?
I got a lot.
Do you know, Brendan?
Well, I know it's called a special administration region.
Yep. Oh, thank you. Now I know he's going to look up. He's going to tell us how many people are in China. So, because I know it's a lot, and that's
I think
the thing.
it's in the billions. I want to say.
I think it is about 1.1 billion is my.
It is a lot. Yeah.
But-
Maybe not. I don't know.
But
That might
I
be
just
low.
want people to wake up and again, you've got to realize this is a concern, and when you go to the ballots in next year and elections in the future, I think that should be a big concern. Like, how is this candidate going to take care of our country and defend us against other countries that are building, and we can't just turn a blind eye.
I will say two things here. Number one, this is kind of a bipartisan issue. I know there's a lot of Democrats that do also talk about combating China and the way that they're growing, but I do worry, are they going to be strong enough? I think some of them just say it because they know it is a concern.
Right.
What are the actions going to be? The other thing that I do want to point out is we talk about Hong Kong. Another kind of region that China does talk about as thinking it's theirs is Taiwan.
I was going to bring up Taiwan.
Yeah. And you talk about Taiwan semiconductors.
Yep.
You talk about the semiconductor shortage. We need companies in our country to do the semiconductors, because if we rely on Taiwan and all of a sudden they get taken over by China, I mean, that is a huge problem. I mean, China can run the world if they're able to take over different things like that.
Oh yeah, and again,
they're not stupid. They're quite intelligent.
Yeah, it's not like
they know what they're doing.
Idiots. Yeah, I mean, they are smart. They do have a different agenda. Our agenda is we want a free world, free country. Their agenda is no communism. We want to control things, and concerning. So I just want to kind of point it out because it's something that could hurt us down the road. And we do have these major things that come up. Maybe the next major thing comes up. It's not a virus, but it's concern on how large China is getting and the control that they have. So.
Yeah, and I will say that that's why I'm so glad Intel is getting involved more in the manufacturing of the semiconductor. Because you look at the major players, it's Samsung and Taiwan Semiconductors. We need somebody in the United States to come in. I know that they're talking about it as part of the infrastructure play is giving money to kind of semiconductors. I hope they don't give money to Taiwan Semiconductors to build. And I know it would benefit American jobs because they would build factories here in the United States. But I'd rather see Intel get that money and have them improve it, because we know it's an American company. We know that Intel's not going to get taken over by China. At least I don't see that happening.
I hope not.
Yeah.
I don't think so.
So I just want to point that out. And the other thing, too, I was going to say, kind of going back, and I don't know if Brendan got the China number yet on people. Did we get that?
Yeah, we got 1.4 billion people.
Wow. 1.4 billion.
Yeah.
And there's how many in the United States? Like 360 million. So that's about four times. 4 times.
Four times.
Yeah.
That's crazy. But I was going to kind of go back to the millennials and the different generational groups. I don't know what they're going to do next, because they had Gen X, which was after the baby boomers.
Right.
Gen Y, which is also known as the millennials. And then we talked about Gen Z. What comes after Gen Z? We're all the way through the alphabet.
Gen A. We start all over again. Or Gen ZZ, because they'll be sleeping a lot. All right. Phone numbers here, 866-577-2473. That's 866-577-2473. We're going to go to San Diego and speak to RJ, who's been waiting very patiently. Good morning, RJ. You're on the Smart Invest Show. Brent Chase, how can we help you?
Well, thank you for your comments, and I appreciate going into this area because there's a lot of concern out here about exactly what you have been talking about. It's been this creeping socialism and so forth, and there's a lot of things that can happen that I think there's a lot of many people are having a very unsettling situation as to how big China's getting, and also they have the great the better amount percentage-wise of our pharmaceuticals manufacturer. I just realized that not too long ago.
Yeah, great point. Yeah.
Yeah, right. That's putting us into a very precarious position because you can shut that thing down to us, and now what are we going to do with the pharmaceuticals? We don't have a manufacturer here. Seems like someone had this America First idea, and they're no longer in the White House. And the voting situation, as you described, very important.
Yes.
I have to agree with you. Very, very important. So, okay. My call is actually about ExxonMobil, and wanted to find out how secure is their yield on their stock.
Okay. We'll look at all the numbers here, because that's what you have to kind of do with a business, see how well they're doing and stuff. And with the increase in oil, That has helped the ExxonMobil substantially because now oil is a higher price. I'm not going to go on the other side because one thing I'm not happy about is that we now are more we're not independent oil anymore, which we were, and unfortunately now we are dependent on foreign countries once again for our oil. So, but let's take a look at ExxonMobil, symbols XOM. We do have no PE ratio over the last 12 months. They have not had full year earnings. We do see the price to sales for the last 12 months is 1.5 versus 3.44. That's a positive. Price to book value 1.7 versus 2.2. Price of cash flow very expensive, 760 versus 9.9. Now they do pay a 5.4% dividend. The dividend payout ratio is 0 because they have no earnings going forward. I'm going to look at some other things while Chase look at the earnings going forward for you, like the cash flow, to see what that's looking like, to see how sustainable this dividend is. We do see that their sales are down 27% year over year, but that is better than the industry decline of 31%. Their earnings per share over the last year, for the last 12 months, down 279%. Something's going on there because the industry is only down 6.7. Now, look at the balance sheet. They do have a pretty decent balance sheet for all the stuff they've gone through over the last year through COVID and so forth. Current ratio 0.8 versus 1.1, a little bit worrisome there. But debt to equity for Exxon is pretty darn good. It's a 40, and that's half the industry at 80. So I like seeing that. Return on equity is a negative 11.3 versus a negative 23. That's positive. Their net profit margin for the last 12 months does check in at 10.9 negative, but the industry loses 33 cents on every dollar they bring in. So again, Exxon looking pretty good there. Their receivable turnover is 7.9 versus 6.9, and then inventory turnover for Exxon is 7.2. That is below the industry at 8.2. So Chase, what about the earnings going forward?
Yeah, so sorry here. Current price for ExxonMobil is $64.66. It's right near the 52-week high. It probably hit that yesterday even, $64.93. And 52-week low, well, that's $31.11. I go out to December 2022. I see estimated earnings per share of $4.50. That would give us a target sell price here of $74.70, which is still a little bit off that current price is $64.66. So it'd probably be placed in our hold category. I don't think I'd be buying Exxon at these levels, especially near that high. So, again, a little bit more room for growth. If you hold it, I'd say probably continue to hold it.
And actually, I mean, you just look around now. I mean, you drive on the freeway, there's no more driving 75. I mean, the freeways are now filled with people, and we're kind of like the last state, almost the last state, I think, to come in and kind of release, open the economies. People release people. Okay, put it that way. Open the economy. So people out there driving. RJ, I said I would look at the cash flow for you because it's very important. If you don't look at the cash flow, you can't pay the dividend. A year ago, which was be March, is what we're looking at for the numbers. Their cash flow was positive. It was only $6.2 billion. It is now $9.2 billion. So I do believe that the dividend with Exxon is safe. We did have concerns about it about a year ago. Could they sustain it? And gosh, they did a great job doing that. Now they got the cash flow. We've got increasing oil prices. So I do believe ExxonMobil will not be cutting their dividend.
I know they took a little flack last year, and we were kind of in that camp as well.
Yeah.
They cut benefits for employees, and I think that was wrong. I feel like they almost should have taken on a little bit more debt even because their balance sheet was okay. But it's kind of hard to continue to pay a dividend, but cut stuff for your employees. And I know you have to take care of your shareholders, but you also have to take care of your employees, which are also likely shareholders.
And we didn't hear if they brought those benefits back or not.
I'm sure they did, but I can't say for sure. So, it was of concern last year, but I think it looks okay now, and it's a good name. I do wonder as well. We talked earlier in the show about oil not going anywhere, but I wonder if they are doing anything kind of in the green energy space to kind of help offset potential headwinds there that might be coming in from the administration.
I can't say specifically, but I'm pretty sure that we hear a lot about Exxons and the Chevrons, that they are doing other things. Now, the thing that I look at, RJ, is they're not going to be as profitable. And RJ, I forgot, you said you hold it or looking at buying it?
Look to buying it.
To buying it, yeah. And so at this point, we wouldn't buy it. And the thing I was going to say, too, was trying to get green energy and so forth. I just don't believe it'll be as profitable in the beginning. But with ExxonMobil, it's got a nice dividend of that 5.4%, but it's too expensive. So, and again, we've been saying this, markets don't just go straight up. There could be a pullback, could be a correction. So watch it because you will get a better dividend with a pullback, but we would not buy at this price. All ready?
Thank you for your service. You've done something very, very noble, I think, for the community that you're spending this much time and trying to explain things other than stocks itself. And thank you again, and appreciate it. And I'll keep on listening.
Okay, RJ, and thank you for your kind comments, sir. We appreciate it.
Thank you.
Bye-bye. All right, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Steve. Steve, you're on the Smart Investment Chase. How can we help you?
Hey, good morning, guys. I'm on my second cup after that Padre game last night.
I know it was a longer game because they scored so many runs.
Yeah.
We could have shut it off halfway through, but it was just still fun to watch.
Yeah.
What's going on?
A couple of things real quick. I wanted to talk about the deregulation of these big tech companies. With a new kind of person at the helm like this, are companies kind of like Google, Facebook, Qualcomm, who have faced antitrust and FTC cases already in the U.S. and abroad in Europe in many cases, and have had the decision, right or wrong, are they now susceptible to another round of investigations and potential lawsuits, or is there now like double jeopardy in that aspect?
I would say that they are subject to another round because she has a kind of different agenda than what the prior commissioner had as well. So, and I think it's less of kind of what we've seen with the fines. I mean, it's interesting when you look at some of the fines. It's like, oh, it's a few $100 million. Well, it's nothing to these big tech companies. I mean, they make so much money. It's like,
got $50 billion in cash.
It's like getting a speeding ticket for $200. I'm not happy with it, but it's not going to completely derail you. The concern here is if they come in with new regulations and say, well, actually, you can't do this. It's more the rules that she could create that could limit growth rather than coming out and suing them and kind of going that antitrust type litigation route.
Yeah, and it's not. Yeah, and it's not that it's over. I think it's always going to be there until the government gets what they want. Or get I don't say the companies under control, but back to more competitive natures. Because if they really, I mean, you can't go out. I mean, when's the last time we had a new Facebook come out? You know, that you can't compete with what they have. I mean, it's just very difficult. And that's what the government tries to do. And I'm not always in favor of the government, but they try to keep business fair so you have new innovation come out and competition, keep prices low. So I don't think the regulations and the fighting against the tech companies is over. I think it'll be on until eventually we see them broken up.
I mean, a great example is like on Facebook. You're able to say things and do things that you aren't able to do on, let's say, radio and TV. Yeah. And it's very interesting that you can post like a video, again, video content, and say something that's out of compliance on TV and radio, but it's okay on social media. So there's some things that I think need to be implemented. I'm not saying I'm a big fan of regulation, but I think there needs to be kind of more of a level playing field for some of these companies.
Yeah. And unfortunately,
that's a great example there.
Thank you.
Yeah. And unfortunately, I think the big companies, their stock prices will be hit because they're going to spend more time on this. They got to divide things up. We talked in the beginning about how Amazon by itself on the retail side really is not profitable, and it's going to hurt shareholders. So, and this happens all the time. I mean, I think Amazon trades at, 40, 50 times earnings? I mean, things go up, and there's something that changes, comes down. And I congratulate people that made a lot of money on it. But I also know people like, oh, I'm going to buy Apple and just not look at it in 20 years. That's not a good thing to do with investing because things will change in investing. So you always got to watch your businesses that you own, even if they're public companies. All right, Steve.
Thanks, guys. And then one more one more ticker while we're on topic with the oil. I'm looking at some of these beat up, especially offshores, and I scooped up Transocean for about 3.5. Ticker's RIG, RIG, and I'm wondering how much longer I should hang on to it or just cash out my winnings.
It's funny. That's one that I've wanted to buy because I held it, I would say maybe 10, 15 years ago, made some good money off it. And I've seen the same thing, like, wow, it trades at like $3 a share. Is there something good here? So let's take a look at Transocean Limited, symbol is RIG. Unfortunately, no PE ratio, but that is the same as the industry. We do see price of sales looking good, 0.9 versus 1.72. Wow. Price to book value, 0.25 versus 0.98. That's tangible book value. That means you're paying 25 cents on the dollar for the tangible assets of Transocean. We do see price of cash flow also looking good, 3.9 versus 10.5. They do not pay a dividend. We do see that their sales were down 1.5% year over year, but industry down 43.8. Earnings per share did climb by 78%, industry up 29%. So I'm like seeing their growth on their sales and their earnings changing around there. On the balance sheet, well, still got a good balance sheet. A current ratio 2 versus 2.4. Debt to equity 67 versus 43. So I'm okay with that debt to equity. Return to equity is still a negative 2.4 versus a negative 35. Net profit margin checks in at 9. That's a negative 9, but the industry is negative 71. And then we do see receivable turnover of 5.2 versus 4.1. Inventory turnover of 4.3 versus 9.5. Chase, what do we got for earnings going forward here?
Yeah, so current price here for Transocean, again, ticker symbol is RIG. It's $4.44. 52-week high here, $4.81. And wow, you're going to make a lot of money off this stock if you bought it when nobody wanted it. It traded at 65 cents. I mean, the price to tangible book value, you said it's 0.25 right now?
Yeah.
I mean, you're talking about, what was it, in the 0.0 something?
Yeah, you will pay you to buy our assets, our tangible assets. Yeah.
I mean, they were on the verge of it all being over, and now they got. Well, I guess there's a delay in a couple exploration ships coming out of Singapore or something. But there's good news, and they're doing business. They're getting their Chevron contracts, Dutch Shell contracts again. Oh. I don't know. I'm happy with what I made. Like I said, I picked it up at 3.5. But do you see it keep going?
Yeah, so this is the issue here, Steve. I look forward to December 2022. Unfortunately, there's no estimated earnings. And this is, they're estimated to lose 74 cents. And even the high analyst here, I look at this, there's, 12 analysts. The high analyst says they'd lose 43 cents. So they're not estimating money, which means we can't derive a target sell price. I will tell you, it's very tempting because of that price tangible book value. I mean, in theory, things should trade at close to 1 times tangible book value. So there could be appreciation there. I don't normally do this, but I'll point out the cash flow per share is estimated to still be 46 cents.
Right.
So per share. That means that they might be able to still pay their bills and might not need to take on excess debt. Can they pay their interest rate on that debt, however? So there's some intrigue here, I would say, but it's I want to say I like it, but it can't get that target sell price.
Yeah, and the problem, too, is that the company is doing the right things. I mean, a year ago, their debt was $9.1 billion. That's now $7.6 billion, so they're paying down their debt. Also, too, their equity is holding strong at $11 billion. But I've done this before as a mistake where you got a strong balance sheet, but it just doesn't go, especially with no analyst showing a positive thing here. So you've got a strong business that I think can turn things around, but it may take 5-10 years. It's just not worth it because, as Chase said, there's no earnings going forward. That's not something I want to be invested into. As much as I would like to say it is, it's just not.
Yeah, and the thing is they have a strong balance sheet now. Are things going to change? And if they're not able to turn that profit here, that balance sheet could look terrible in 5 years. So it's something to be cognizant of. You've done well with it. It could go, let's say, to $8 a share, and it could double. But, it also could worsen, and things could be a big negative here. And it's just when we don't see estimated earnings going forward, we know we miss some companies, but we don't like to take that risk.
Yeah, and Steve, I mean, it's kind of like a gamble here, and sometimes the gambles pay off, but we can't tell you that's a good investment because it's just not there with the earnings, and that's why
I'll probably set some limits for Monday and maybe take my 20% and buy more Padre tickets.
There you go. Get the good seats there.
I really like the show, guys. Listen every weekend. Have a good one.
Thanks for being there, Steve. Appreciate it. You have a great weekend as well. Bye-bye.
Bye.
All right. That opens the phone line, 866-577-2473. That's 866-577-2473. Before we go back to the phones, let's go to our financial planner, Harrison Johnson. Good morning, Harrison. How you doing this morning?
Good morning, guys. Doing well. How about yourself?
Well, good. We talked the other day that people say, well, where are you at today? So you're kind of becoming our travel expert. Are you in San Diego? Are you out of town today?
That's what everyone always says. So today I'm in San Diego, but next week with the 4th of July, I'll be out of town. I'll be in Arizona at the lake. So I'll probably be calling from the lake next Saturday.
All right, you give us a report next week from
Arizona.
Arizona, yes.
Well, I will.
And I will say, to be fair, you are from Arizona, so you go back to see your family. It's not like you're just traveling all the time.
Yeah. It's for the families back home. So,
well, today we're talking about self-directed IRAs, and how does this fit into financial planning, Harrison?
It's a good question, and I actually see this fairly often. 2 people I've talked to in the last week have self-directed IRAs. So usually when you think of an IRA, you can have an account at like Charles Schwab or something. You can buy stocks, bonds, that kind of thing. But also you can use an IRA, a self-directed IRA, to invest in real estate. So that could be residential, commercial, land, trust deeds, notes, all kinds of different real estate investments you can hold inside IRAs. And so at the end of the day, when we have an IRA, whether it's invested in equities or real estate or anything else, the purpose of it is to grow your wealth over time and then eventually use that to generate income for you in retirement. But we still have the same type of issues of, well, anything that comes out of that IRA, whether it's a rent distribution from the real estate that you have, or a distribution from the cash that you have from a stock portfolio or whatever, it's all taxable income at ordinary tax rates. It's all subject to RMDs when you turn 72, hopefully 75 if this bill goes through Congress. So, it still is a part of your overall financial plan. And, I talk to a lot of people and they're like, we have a different situation. We have an IRA in real estate. Can you help us? And the answer is absolutely. I see it fairly regularly. We still need to understand it and make sure it's working for you, and then look at the tax implications of it to make sure that it's going to benefit you in retirement.
And I will say, too, that there's some things to be very cognizant of. I know the rules are very, I'm going to say, difficult to kind of manage. And if you don't follow the rules, the penalties can be quite high.
Absolutely. So with a self-directed IRA in real estate, there's a lot of extra paperwork. There's a lot of extra regulations. A lot of time that translates into extra costs because you have to have a third party do pretty much everything. So, for example, you cannot use the real estate yourself. You can't go and fix anything yourself. You can't buy or sell to any type of related party without running into huge tax consequences and penalties. Actually, so a quick story on that. Chase and I, when we were in college, we went down to Mexico for spring break.
Should we continue on here?
But when we went down there, we stayed in my neighbor's penthouse. And so after the fact, I found out that penthouse was actually held in an IRA that she owned, but she used it for personal use all the time, which, again, you cannot do that. If the IRS ever found out about that, she would have a huge tax problem because of it. Again, they're very strict on that kind of stuff.
Oh, I can imagine. And one thing that kind of surprised me was I believe you said that if you hold it, the real estate in a self-directed IRA, you can't even fix the property yourself?
No, if you get a leak or something, I mean, you'll still have tenants. But if you need to replace something, you have to hire somebody else, go pay someone else to go out there and then pay for the cost, all with money inside the IRA. If you go in there and do it yourself, it screws everything up. So, yeah, you have to be very careful with it.
Yeah. And also, too, I want to talk about the custodians. I know we were talking to a couple this past week that had one, and they're done with it because it's just way too hard. And I know he's in construction, so he wanted to kind of do it himself, and he can't. But the other thing is the custodians. The custodians are not Charles Schwab. They're not, TD Ameritrade, E-Trade. They're not these kind of big companies. They're a little bit hard to find, and I think sometimes the customer service is terrible.
And I think they're expensive too, aren't they, Harrison?
They are, and a lot of times, you have the custodian themselves who actually, holds the asset for you, and then on top of that, you have a separate third-party manager or the regulation and compliance side of it to make sure you're doing everything correct. So you have all these moving parts, and for them, it's been such a hassle that they really haven't been able to do anything for a couple years now, just because, it's at a standstill. They can't get a hold of anybody. They can't do the things they want to do. So, investing in real estate definitely has advantages to it. There's also a lot of disadvantages, and when you add the IRA side of it, it just makes things very complicated. It can be done, but there's a lot of things you have to really be careful about.
And Harrison, I want to point out that that's why you're on a salary. You don't sell product, because if somebody comes in with this, you're not going to say, oh, sell this and buy these mutual funds. You're going to say, okay, well, if that's what you want, we're going to work with it, but we got to do it right. You're going to guide them to do it the correct way. And had you, I think you said your neighbor from Arizona, she come into you, said you cannot stay in your own place if it's in your IRA. So you guide people correctly to make sure they don't get caught. Because I'd imagine if the IRS caught you on that, oh gosh,
it
all
would
becomes
be a
taxable, right, Harrison?
What's that? What happened?
It either all becomes taxable or a huge chunk should become taxable, depending on if you use it or you fix something. There's all these little intricate rules, but none of them are good. It's not like a slap on the wrist or something that can be corrected easily. It's a problem. And at the end of the day, as you said, Brent, my job isn't to say, okay, you need to sell this and buy something else. It's, well, let's look at the asset. How is it performing? What's the cash flow? What's the overall return that you're getting? Do you have a mortgage on it, which also complicates things from a tax perspective? Mm-hmm. So, if it's working for you, great. If it's not, then what alternatives can we look at, or how could we make it better?
Yeah, and that's one thing we do at our firm. Investment-wise, we explain to people what things are, and as a financial planner, you explain what they are, because I had no idea that, and now I think about it, I can see it, that if you did not follow the rules for your self-directed IRA or the real estate, the IRS could say, well, sorry, it's not a retirement account, and therefore that $500,000 piece of property you have, that is now all taxable because it's not in the IRA. It's not treated as an IRA. Is that correct? Just confirm.
In some cases, yeah, that is the case. It becomes taxable, and then if you're under 59.5, there's the additional 10% penalty on that. So, it can be a huge, huge problem.
Right. And ignorance of the law does not help you, does it?
No, not when it comes to the IRS.
That's why I need a good financial planner. Harrison, thank you very much. We'll see you on Monday.
Thanks, guys. We'll see you Monday.
Okay, bye-bye. Again, as Harrison Johnson, our financial planner, he is a CFP. He is separate from our investment side. He is on a salary. We do charge fees for the financial planning, so he's biased. He's there to work for you. If you want to have a free consultation with him, you can call him at the office, 858-546-4306. That's 858-546-4306. And if you currently have a financial planner, I encourage you to compare. You compare your car insurance. You compare different things you're buying. Compare your financial planner. Go talk to Harrison, find out what he has to say, and see if it's a better job than your financial planner. Yep. Again, you're planning for your retirement, for your future. Gosh, why mess around with it?
Yeah, definitely.
Yeah. All right, phone number is 866-577-2473. That's 866-577-2473. We finally have the Facebook Live up and working, yes, for the past 2 weeks. And I guess Brendan said that there's something crazy going on with the iPads. We always use on the iPad, and he said, we're not using the iPad this time. We're using the actual iPhone, working better, but something crazy. Do you want to explain, Brendan, quickly what's going on with the iPads?
I've been just looking up internet boards, and everyone's complaining about iPads and being on Facebook Live, and it's just choppy audio. So we're using your phone instead, and it's working perfectly. So no complaints now.
All right. Well, that's good. Where's it going to go with that? Oh, going to go back.
We're going to go to Facebook for the question.
Yeah. I see Jason has a question. Chase, can you read the question for us?
Yeah, so he wants to look at a company, but also kind of had a quick general question. He says he has a Roth IRA funding question for the past 6 years. Simply put, all $12,000, both his and his wife's Roths, fully funded on January 1st each year. Would it be better to space that out and buy every few months? I know it's impossible to time the market, but I have fully funding and let it run. Thanks.
Yeah, and this is one thing that for, 20 years, 30 years, I've been in the business 40 years. Even back when IRAs first came out, you always want to fund it first of the year. Reason being is that you get the deferred compounding. And now what you have to do is kind of what we do is you can't just say, okay, I funded it, I'm going to buy something right away. Yeah. But if you put it into the Roth or the traditional IRA as well in the beginning of the year, you had that compounding, or not compounding, but that growth, that return that will not be taxable.
And I'll say some years it'll pay off more to invest it all at once, and some years it'll pay off to kind of spread it out over time. Because if you spread it over time, you might have missed the beginning of COVID last year and then got to buy it on lower dips. But also on
Right.
the other side, if you would have fully funded, let's say at the end of 2018 or the beginning of 2019, when we had that big pullback, would have made more sense to fully fund it at the beginning of 2019. So you're kind of accomplishing the same goal because you're still funding it each year in and year out.
Yeah.
So I as I said, it's going to be some years it works better to fund throughout. Some years it works better to fund it all at once.
I disagree with you because, again, to fund it is important, but to invest it is something different. And that's why I'm looking at how we do stuff. Is that we are times, I mean, if somebody gave us, the $6,000 on January 1 of 2019, I think it was, we may have not invested it throughout the year, but you want to get it in there because, and the other thing too, if you had it outside of the account, and you're earning something on it, you'll pay tax on it. So I'm going to disagree. We disagree again.
I'm going to disagree with your disagreement.
Well, no, I didn't finish my disagreement yet. Hold on. My disagreement is that you should always fund at the beginning of the year because you don't know what's going to happen throughout that year, and it can benefit you more than it can hurt you.
Yeah, so the thing I look at is...
Oh, wait, time for break. Got to go.
Is when you look at it, though, I mean, as much as we took caution at the beginning of last year, we didn't buy everything at the absolute bottom. So my point being is you're going to kick yourself sometimes is, I should have funded it throughout rather than all at once. But I used to fund monthly because of cash flow.
Right.
So it also depends on your cash flow. If you don't have $6,000 spread it out. But to me, as long as you fund it within the year, you're doing a good thing.
Yes.
And, if you fund it all at once or you fund it throughout the year, I'm indifferent to it. I know you have your preference.
Right.
I think it works either way. And I think you're going to have some benefits and then some benefits other times.
But you didn't answer Jason's question.
I didn't. I took a very political answer by going around it.
There you go. So actually, I guess we've done nothing because you think it might be okay to fund it throughout the year. I'm saying no, you should fund it at the beginning of the year. That's in finance books. I believe you should do it.
Where is that in finance books?
Oh, time for that break again. I know it's written somewhere. It's written down somewhere. But, and I was going to say, and plus I've been doing it for 42 years. So it's just like, I've had experience. But you are right, though. If you obviously don't have the money, it is far better to do it throughout
Don't put it on a credit card and go credit card debt.
Didn't even think of that one yet. Don't do that one. Yeah. So, So, Jason, so you can decide who you want to go with. I'm saying fund at the beginning of the year. Chase is saying, okay, fund throughout.
I'll give Jason an answer. Since he's already funding it fully, just continue funding it fully.
There we go. There we go. We like that. Well, shoot, we got 6 minutes left, and we had no phone calls. This has not happened in a long time. Phone number is 866-577-2473. That's 866-577-2473. All lines are open. What do you got there, Jason?
I was going to say, Jason, I was also curious about Cigna. And I know that's an interesting kind of healthcare play, so I thought it'd be interesting to take a look at Cigna before we close out this first hour.
Is there a symbol CI?
CI.
Well, that doesn't sound like a Cigna. I thought it'd be CIG is what I thought it would be, but I guess not. So let's see who comes up here. We'll talk about Cigna Corporation. Symbol is CI. We do have a good start here. I'm liking this. PE ratio 10.2 versus 29 for the industry. Price of sales 0.5 versus 1.0. No price to tangible book value for Cigna or the industry, but price to cash flow for Cigna is 7.2 versus 10 for the industry. So you want your valuation ratios lower than the industry. We do see Cigna pays a 1.7% dividend. I'm checking this number. That's a pretty decent dividend, but they only use 4% of their earnings to pay that out. That's a pretty low payout for a decent dividend. We do say sales year over year were up 5.8% above the industry at 4.1. Earnings per share for Cigna climbed by 78.7 above the industry at 65.4. It is a financial company, so there's no current ratio. Debt to equity is 66.4 versus 120. We do see return on equity is 18.1 versus 12.3. Net profit margin checks in at 5.2 versus 3.8, and no receivable or inventory turnover. Chase, what do you got for the earnings going forward?
Yeah, so looking at the current price here for Cigna Corporation, it's $237.10. 52-week high, $272.81. So we've seen a little bit of a pullback here, but it is still off the 52-week low of $158.84. If we look at December 2022, I see estimated earnings per share of $23.13. that would give us a target sell price of $383.96. So good appreciation there. And one thing I'll point out that I really like to see as well is that earnings growth is occurring quite nicely. I mean, I look at December 2020, they made $18.45. This year, they're estimated to make $20.43, and then next year, $23.13. I mean, that's pretty sound earnings growth and at a very good valuation. I gotta say, I like this one. It's in healthcare.
Yeah.
It's the insurance side of the healthcare. I'd want to know a little bit more about kind of what they service, essentially, who their customers are, but definitely intriguing.
Yeah, because I think they are just a healthcare company. And again, before we say yes, this is a good buy, because it does look like a good buy. I will also point out that I like insurance companies. I learned a long time ago from Christopher Davis, Shelby Davis, well-known value investors back from the 40s and 50s. They started. Insurance companies always do very well. And that's not changed, 40, 50, 60 years later. They're not going to double in price. But when you invest in a good insurance company, over time you can make a decent return. We'll say 10, maybe 15% is what you could get off a good insurance company. So you're not going to get that 400% pop on it, but it's a good stable in your portfolio. But again, I would want to know what they do on insurance. I think they are in healthcare, which could be crazy.
Yeah.
But do they also sell other things like life insurance or other types of insurance as well? So I'd want to know that. But I think it's worth a research on this one. I like it.
Yeah, I mean, it looks like it, just kind of pulling it up here, it looks like they just focus on health coverage. So
Really?
yeah. So I like it. I'm going to give people a little secret here. I just added it on my phone to my watch list.
We gave that secret away?
I gave that secret away.
Oh, wow. Okay.
So what that means is I'm going to go do research. I'm not going to give people the answer if we like it or not. I'm just telling people.
Right.
I'm going to look into this one. It
Right.
looks intriguing.
And that does not mean you go out and buy it because we put it on our watch list.
Yeah.
It means you do the research like we're going to do it. And if you want to do that, well, you can come in and become a client, and we can kind of show you what we're doing.
Yeah.
So, but, Jason, I hope that helps out there. Great questions. And, Jason, gosh, he's been following us for, 10, 15 years? It's been a long time.
Long time, yeah.
Yeah, a long time. So we appreciate that.
And he's not even in San Diego. He's in, where is he? Wisconsin, I think.
Wisconsin. Yeah, I think you're right.
You
He
can
does
correct us there on Facebook if I'm wrong, but
Yeah. Yeah, I know, because I know he's listening. Yeah. So, and what's funny too, and maybe because we've not been on Facebook for a couple of weeks now, we used to get like 3 or 4 people from Facebook, but kind of Facebook is slow too. I do want to point out, I do see Miguel in San Diego. You'll be coming up first out of the break when I come back. You want to call in. The phone numbers are 866-577-2473. That's 866-577-2473. We will definitely get to you. Got the full hour. You had something to comment to, Jason?
Oh, I was just going to say, I think people must be sleeping after that Padres win last night. Must have stayed up late.
I hate to say this because we left. We did leave a little bit early. Was the final score, did it change in the last?
It was 11-5, I think it was.
11-5.
Yeah.
So I think we missed it. I think because I left a little bit early, so I think I missed a run or two. And as I was walking out, I heard the cheering, like, oh, shoot, I think something happened.
Yeah.
But it was a great game. I mean, gosh, just so many good things going on. So, but, all right. So, yes, we do have all the phone lines cleared up. So if you want to call in again, 866-577-2473. You got an investment question. You want to know about a company that you're looking at buying. Maybe on your portfolio, not sure if you'd hang on to it or you should sell it. Maybe buy more of it. That's the other thing to look at, too. That's what we're here for, to help you out, help try to guide you through the investment world here, so to speak.
Yeah, no, it's that's what we're here for, and hopefully we get some callers picking up in the second hour here.
Well, I just looked over. I say Brendan just picked up the phone, so somebody was smart to get in early. Yeah, so,
perfect.
Yeah,
Perfect.
yeah. So we'll have some good calls coming up. And as always, we're here to answer those questions for you. And again, we can talk about the stocks. You have investment questions that maybe just new to investing. We're here to kind of help you guide over the myriad of different questions in investing. So Stay with us. We'll be back in about 2 minutes, I think. Yep. All righty, welcome back. I don't think that was even 2 minutes that we had a break there. Gosh, got to get a little bit longer break. I mean, I barely get to take a sip of water. Like, oh, we're back on again. But we love being here. We love answering questions. Phone number is 866-577-2473. That's 866-577-2473. If you just tuned in, you are listening to the Smart Investing Show. Brent and Chase Wilsey. Gosh, been doing the show for 28 years. So hopefully you're enjoying the show. Here to answer your questions. With that said, let's go out to San Diego and speak with Miguel. Miguel, you're on the Smart Investing Show. Brent and Chase, how can we help you out?
Hey, I really love your show, first off.
Thank you.
So thanks for having me on. And I love your workshop as well. I was there a couple of weeks ago, so it was a great time. By the way, so let me just jump into my question. So there's this company called Silvergate Capital that I made a boatload of money off of. I bought it near when the IPO happened, essentially. And I want to know if it has some upside to it still. It's sort of staggered, right? Begin to sort of plateau, you can say, around the time of the election. And I want to see what, in terms of its actual value and its current price, like what the difference really is, so to speak.
And Miguel, I'm curious, what does this Silvergate Capital do? Sounds like a funding company or something. What do they do?
Well, basically, it's a bank. So originally they started out, giving home loans. But now they ventured into providing services to crypto companies. So if you talk about eToro, they use them, which is a crypto company. Like, it's a trading exchange. But it's great because it's not directly correlated to the price of crypto, but it still does benefit from the crypto market, from business, the transactions and things of that nature. And they have their own API that's programmable and things of that nature to support crypto companies that are either emerging or, that are operating currently.
So Miguel, do they make money off of crypto just on the transactions, whether it goes up or down, or how does that work? Do you know?
No, I looked at the site. It looks like they make money from the services they provide. For example, exposing APIs to transfer money and sort of provide the backing of the back end for a lot of these services. That's as far as I really know. I don't know like the deep technicals of it, but that's about it. Okay. And in addition to that, they have regular like checking accounts and home loans and things of that nature as well.
Yeah, I was going to say, it looks like when I just kind of look at the profile of this company, they do a lot in the real estate side. I'd just be curious the breakdown of their services, kind of where they're making money, because we do talk about interest rates rising. I do worry about that for mortgage lenders because it's not going to be as easy to generate like refinances, and even home loans I think will be less common. I mean, we saw that huge surge last year. So just something to consider. And I was going to say, it's funny, we can maybe go ask what this company does after the show. They're here in La Jolla, and their address is 4250 Executive Square. I think it's somewhere in this area.
Yeah, it's right over here. Yeah, I can almost see it from here.
That's another great part about it, right?
Yeah.
And we'll go over there. It's like,
that's another great part of it. Yeah.
And I'm always afraid to do that. You go over there, it's like it's a one-person office. Okay, but again, it is worth looking into if you're in the company. Let's look at the numbers here for Silvergate Capital Corporation. Symbol is SI. We do see not a great start here, Miguel, because the PE ratio is 61 versus 12 for the industry. Price to sales are expensive, 25 versus 2.9. Price to book value looks okay. It's 3.6 versus 1.6. And price to cash flow is 65 versus not material for the industry. So the valuation ratios kind of feeling kind of high here. They do not pay a dividend. We do see year over year their sales are up 2.2%. The industry's up 0.2%. Their earnings did climb by 58%, well above the industry at 14.7%. Looking at the financial strength here of the balance sheet, and they are a financial company, so a little bit different balance sheet, but their debt to equity is only 2.2 versus 313, so there's not going to be much debt on the balance sheet, which is a positive. Return on equity is 7.2 versus 10.7. Net profit margin, they have one, and it's very good, 33.6 versus 24.7. Chase, I'm curious on the market cap and the earnings going forward on this company.
Yeah, this company's pretty sizable. I mean,
Really?
it's obviously not as big as your big banks, but it's got a market cap of about $2.7 billion. So it's a decent size there. Looking at the current price, $102.33 for Silvergate Capital, 52-week high, $187.86. And kind of as you said here, Miguel, made a boatload of money off it. I see the 52-week low, $12.05. So it's really done quite well off of that low there. I'm also kind of surprised it's pulled back as much as it has, but something to kind of be cautious of. Especially if I look out to 2022, I see estimated earnings per share of $3.32. Would give us a target sell price of just, let's see here, $55.11. So it is still expensive. I do worry. I know you said they don't make money off the price of the cryptos, but it looks like it might be trading with the cryptos in terms of where they're kind of sitting in terms of their price depreciation lately.
And I speculate because I used to have back in the '90s. I was worked for a company for about a year, I think it was. Our office was at 4225 Executive Square, and on the bottom floor was a bank. Now I don't think it was this bank, obviously, but I'm wondering if they're on the bottom floor in that banking area there. So if we get some time, I might want to go check it out. I think we have a slow week this week. We don't have a workshop, so maybe we'll just swing by and kind of check it out. And Miguel, since you hold it, we should see you there checking out as well.
Right.
It could be it. It was founded in 1988.
Yeah, very well could be. Yeah. Miguel, well, thank you very much. That's a great call. We wish we could say buy more of it, but it does look like a sell based on what we have. But I think I would love to go check it out.
Yeah.
So, all righty?
Okay. Thank you. Thank you very much.
All right, you're welcome. Have a great one.
All right.
Bye-bye.
You too. All right.
All right, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's go back out to San Diego and speak with Kathy. Kathy, you're on the Smart Investor Brent and Chase. How can we help you?
Hi, good morning. So thank you. I love your show and I appreciate your taking my call. I was curious about Macy's, stock symbol M.
Okay, well, we appreciate you being there and calling in. Got to ask you, Kathy, do you shop at Macy's?
Yes, I do.
Good, okay.
I'll always have.
Always have, yeah. Because I know my fiance does as well. And they've got some great deals. We've got some good buys over there.
I was going to say, it is always funny when people say, I want to ask about Macy's. Do you shop there? No, I hate Macy's. Probably don't buy it.
And
well, that's good you shop there.
Yeah, so we know you shop there, Kathy.
And I'm not saying I hate Macy's. I was just saying it's funny when people say
that. Do you own the stock or looking to buy it?
I do. I do and have for some time. So just curious. It's had quite a nice, run since opening, with post-COVID. So just thought I'd like your opinion.
All right. Let's take a look at Macy's Incorporated. Their symbol is M, as in Macy's. Unfortunately, Kathy, no PE ratio versus 67.9 for the industry. Price to sales, looks very good. 0.3 versus 3.7. Price to book value, 4.3 versus 20. That's phenomenal. And then price to cash flow, also looking very good for Macy's, 8.9 versus 25. Again, the valuation ratios, you want them lower than the industry average. I know they used to pay a dividend. They no longer pay the dividend. We could see that dividend come back. We do see sales are down 13.1% versus the industry up 33.7%. However, earnings per share for Macy's were up, and this is year over year for the last 12 months, 92%. But the industry was up 455, and I'm okay if a company grows their earnings at 92% year over year. The balance sheet is not quite as good as I would like to see it. We have a current ratio of 1.3 versus 1.1. That is okay. What I don't like seeing is a debt to equity is 181 versus 59. And you really got to check that debt to see what it is. But that's an awful lot of debt. I don't like to go much above 120. When we see return on equity, that's a negative 9.6 versus a positive 27.7. Net profit margin is a negative 1.3. The industry is a positive 5.4. We see receivable turnover is 105 versus 21. That is good, but inventory turnover not so good. 2.8 versus 8.2. So I'm kind of unhappy with that because we want that fast turnover on their inventory. Jace, what about the earnings going forward?
Yeah, so current price here for Macy's, $19.62. 52-week high, well, that's $22.30. So pulled back a little bit off that high. And 52-week low, well, that's $5.57. Now I got to January 2023. I see estimated earnings per share of $2.09. Would give us a target sell price of $34.69. So the value is there with Macy's. One thing I do want to point out, however, is this year they're estimating $2.16. I would think next year would accelerate even further. But I will say there is one analyst that says next year they'd make just 65 cents, which I think is bringing that down. But I still just want to make sure there is that growth story there. And obviously very easy to grow off of last year's numbers because they lost $2.21 because of the shutdown. So they're growing this year, but I want to see, can they sustain growth moving forward? And I know, I think the CEO's Jeff Gannett, I think is his name, and I know he's been quite prominent. I think he's doing a pretty good job. It's hard being in the malls, though, I think is the difficulty for Macy's.
And Kathy, I know we over the last year or two we've kind of looked at buying Macy's and so forth. And again, as I told you, my fiance, she shops there, and I go with her shopping and so forth. Some of the deals you get there, I mean, she found these gold earrings for like $1,500. By the time she did and the salesperson did whatever, we got the earrings for $450, which is a phenomenal deal. But I'm looking on the other side. What kind of profit they make off of that, you know? And it's not just that one. I mean, they have a lot of great deals there for shopping. So, and I guess maybe that keeps the people there, but I do kind of worry with that, and I don't like that high debt. So, percentage-wise, how much does it make up of your portfolio, Kathy?
Not too much.
Not too much.
Well, 15%.
15%?
Yes.
Okay, now that's pretty high. I mean, usually when we get to a company, we'll say 12 to 15%, we start paring it back because we initially buy about 6% of a portfolio. So 15% is pretty high because if that debt becomes a problem, or as Chase said, their earnings start declining next year, that could really hurt your overall portfolio.
Especially, do you own any other retail in the portfolio there, Kathy, or is just Macy's it?
No other, just that.
Okay, there's something else to consider. But yeah, 15% is a little high. If you understand the debt, I mean that's my big holdup with Macy's.
Yeah, and one thing that you may want to consider, Kathy, is selling some of the Macy's and then buying another retailer, but we like to buy the companies that actually manufacture the products. That's what we like to do because sometimes the retailers get caught in the middle. So maybe find a good company that makes a great product that you like, maybe. So, all righty?
Okay. All right, great. Thank you both so much. I appreciate it.
You're welcome. Thanks for calling. Have a great one. Bye-bye.
Take care.
All right, that opens the phone line, 866-577-2473. That's 866-577-2473. Chase, what do you shop?
I don't shop.
Well, I don't really shop either. Whenever we go shopping, it's always Christina, my fiance, that's doing the shopping. I think once a year, like, I want to buy something. What? But it is kind of nice because I get to go out there, see what's going on. I kind of feel the retail market and stuff. So
yeah, I don't know. Last time I went shopping, we went to like Nordstrom. Actually, I got some cool shirts at Untuck It. I don't know if you've ever been there.
Are they public?
I don't think they're public. I think they're private. So that's a kind of a cool spot. But yeah, I don't do a whole lot of shopping. Yeah, I like to shop at Costco.
Well, there we go. Okay, all right. But it is kind of nice to kind of go out and we'll talk to your fiance Taylor a little bit and say, okay, Taylor, come on, you gotta get Chase out there shopping a little bit. No, just shaking his head. Yeah. So, all right, let's go up to Oceanside. I think it was next, and speak with Joe. Joe, you're in the Smart Bet Show, Brent and Chase. How can we help you?
Hey, good morning, guys. How you doing?
Good. How you doing?
Oh, pretty good. Hey, I don't know if I'd be telling people about all your wild parties on the weekend at the Padre game and coming in a little foggy, because managing people's money,
Well, we don't manage the money on Saturday. We do it on Monday.
I want my guys sharp 7 days a week.
All right. Well, I guess we won't be your guy.
Hey, I'm guessing a self-directed IRA is different than a traditional IRA?
It's still the same function in terms of the taxes, but in terms of the way you direct it, yeah.
And what you can put
okay.
Yeah.
Well, that's something. And the oil companies, I'd stay away from them myself. I mean, I own an oil company, but I've been getting rid of my higher price stuff. I got just low price stuff now for the dividend. But it doesn't matter if they're still going to be in business. It's less is less.
Yeah. Well, profitable. Gonna make a profit.
Yeah, well, it'll change too because the volume might decline, but then, as I said, the margins are going to have to change as well. So then the price might go up, but it's going to be dynamic as always, and we'll see what happens.
And a good example.
Were you guys talking about container vessels in the past? I thought maybe,
I don't think. We talked about Transocean, and I know that they transport oil. I don't know if they use container vessels. I forget how they do it.
Yeah.
I was looking at the container, how much they're charging for containers now. It's like it's just crazy.
Oh, yeah.
How much the price has gone up. and how long they have to wait because they aren't getting employees, and I'm just wondering if it's too late to get in that boat or not. I don't know if you guys looked into that.
Is that a pun that you just did there?
Yeah, get in that boat.
It was not intentional. But have you guys looked into that at all? Because I mean, it's like astronomically way more expensive to rent a container.
We have not, but I almost feel that we kind of missed the
boat.
Exactly. Because I think to do that probably should have been like 6, maybe 9 months ago. So where were you, Joe? Where were you 6, 9 months ago? Bringing it up why you wait till now?
Not looking at that stuff, I guess. And I should have been.
But kind of learn from that. We always try to think ahead, like what's going to happen 12, 24 months from now. So I think again, we missed a container opportunity, but we are thinking, well, what's going to be the big thing 12 to 24 months from now? So. Yeah,
that's a ticket, huh?
Yeah. So Joe.
Anyways, I didn't really call in for this, but I just thought I'd throw it in there as a sticker, SPCE, just because this is, that's just kind of what you do here.
Yeah, and do you hold that or looking at buying it?
Well, I'm sure the fundamentals will be excellent on it, but
well, we do know.
Yeah, I own it, and I'm kind of bummed that I kind of got rid of half my holdings on it, before yesterday.
Because we did see this past week, they had a big pop one day. I forget what it was. Don't know the reason. Was it yesterday?
Oh, no, I know the reason. The FAA approved people flying to space.
I would never fly to space.
Yeah.
But okay, let's look at the numbers here because I'm kind of curious, and I'm sure they make no sense at all. But I'm just curious on how, and the company is called Virgin Galactic Holdings Incorporated. I think a lot of people buy this because of Richard Branson.
Yeah.
He's the man behind it, kind of a genius there. PE ratio, nothing there. The industry's at 1,111. No price of sales. We're not making sales. Price to book value, they have 123 versus not material for the industry. No cash flow. They really don't have any sales, I said. There's nothing there. What is good about Virgin Galactica is they do have a balance sheet, and the current ratio is 5.7 versus 1.4, so they got a lot of liquidity, and no debt on the balance sheet. Versus 132 for the industry. So there's no return on equity, no profit margin, nothing else there. I don't think they have any earnings going forward. Is that correct, Chase?
Yeah. No, I mean, I was just going to look at there's no estimated earnings, but the current price, $55.91. And yesterday, I know this is why Joe said he's bummed he sold half his stake because it was up 39% yesterday.
Just yesterday alone.
Big pop. 52-week low, though, $14.27. And the high, I think it did probably reach $62.80 yesterday. So it did pull back a little bit from the high yesterday, it appears. One thing, too, that I do look at with this company is Virgin Galactic going to be the company that delivers this. I know Jeff Bezos kind of pulled back from Amazon a little bit, I think, to focus more on, I think his company's Blue Origin, which I do believe is going to be a competitor with this. Is there going to be other players as well? That's why this is such a speculative stock, is because there's not really an industry for it just yet. Who are the players going to be that win out? We'll see, and I know I don't think I'd go to space. It scares me.
Yeah, it scares me. I just go on a plane. It scares me sometimes. But the FAA approved just for Virgin Galactica or for the entire industry?
I believe for Virgin Galactic, yeah. Okay. The FAA approval to fly passengers to space, yeah.
And isn't Musk doing something in space as well?
Well, he has SpaceX, but I don't know if he is kind of going for the same niche of kind of like a consumer-type trip. I know he does more like spaceships to actually send people to space, like for science. I don't know if he's involved as much on the kind of a fun trip to space.
He could change on Monday.
Oh yeah.
So Joe, I mean, I think it's a pretty exciting thing to be, because it's like the new frontier, they used to call it, which now, I mean, a lot more people are doing it. I just don't know how it's going to work, and just let unfortunately one rocket not do well. These will not do well. That would delay people going to space for years to come. Yeah. So, all right, Joe, does that help you out?
Well, you got to live a little bit, because they're only going to the edge of space, and the whole thing is Bezos and his brother, I think July 20th, said they're going to be going up in their own rocket, which is just a rocket, like a regular traditional rocket ship, But Virgin Galactic is more like kind of like a plane.
Yeah. Really? Yeah. How
in their future.
How high will that go?
I just think just barely to where you can float, where there's not zero gravity, so they can float around for a little bit.
Okay.
But, Virgin Galactic wants to go, eventually they want to try to use our own airports and go from supersonic travel to country to country. And
kind of like the old.
But it is exciting because you got a billionaire race going on right here. Who's going to be the first one?
I wish I could be in that race, but I wouldn't be in that race.
I don't ever want to go to space. I don't think that scares me. I mean, we'll see. We'll see what happens.
Never,
years, but
never say never, Chase.
I know.
I can say that because I'm older. Joe, thanks for calling. You have a great one.
Okay, bye.
Bye-bye. All right, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Jim. Jim, you're on the Smart Investor with Brent and Chase. How can we help you?
Hi, Brent and Chase. I'm interested in Beazer Homes, or I think it's called. It's BZH.
Yes, the home builder. Do you hold that, Jim?
No, I don't. But I was talking to a guy at work, and I think he got the idea from Investors Business Daily or something like that. But they are kind of concentrated, I believe, in Texas and maybe one or two others. But I was thinking since Texas is growing so much, that might not be quite as much of a problem as normally you might say.
Yeah, and that's one thing that we normally look at. I'm glad you brought that up, Jim, because it is important when you buy virtually any company. Are they concentrated in one region? And, Texas and Florida, they're growing. Now, Florida just unfortunately had that huge condo crash, which I was kind of wondering, could that kind of hurt the market there a little bit on the real estate side? I don't know. But I would rather have a home builder that's nationwide because of things can change in one region quickly, and all of a sudden, that's all you got.
Sorry to change the subject here on you, Jim, but I was going to ask you if you know why that condo collapsed in Florida. I saw an article, but I didn't get the chance to read why it collapsed just yet.
I've been meaning to do that.
No, I haven't either. I haven't read anything. And it was built quite a few years ago. I was thinking maybe it was built like in a hurry during the boom times in 2007-8. But I heard it was built.
And I read
30 years ago.
Yeah, I read something briefly on it. I also wanted to see any video on it to see what it kind of looked like. But what I read, it was built, I believe, 40 years ago. And in Florida, there is a 40-year inspection. I did see, and this would always pop up, like somebody a couple of years ago, this building's not safe. They always find somebody that says that. But I've not done a total research on it. I mean, it's not really what we do, just curiosity. But I
did. I also heard that somebody's grandmother had called them and said that the building was making a whole bunch of like weird creaky noises, like 2-3 days before the collapse.
Yeah. I would think that would have to affect the condo market in Florida.
That's just terrible.
Yeah, I would just be afraid, like,
yeah.
Yeah, do I really want to buy a condo that was built 20 years ago, maybe even 5 years ago, because it was 40 stories high? That's pretty frightening.
Right.
Yeah.
Right.
Terrifying. I mean, I saw the aftermath in the picture. It's crazy.
That's terrible. Yeah. So, well, let's take a look at Beazer Homes for you. Their symbol is BZH. We do have a great start here. I mean, the PE ratio is 7.6 versus 41 for the industry. Price of sales looks good as well, 0.28 versus 0.9. Price to book value, wow, 0.97 versus 15.67. I say wow, because for a home builder now to pay less than $1, 100% for their book value is just shocks me. I'm surprised. We do see that the sales, unfortunately, were only up 1.2% year over year, but the industry is actually down 1.6%. That's surprising to me. Earnings were up 180%. The industry was up 945. Look at the balance sheet, no current ratio, and this is not a financial company. I'm kind of curious why they don't have a current ratio.
It's a home builder. Home builders don't have current ratio.
Oh, that's right. What I was saying. Okay, yeah. So they don't have the current ratio versus 1.56 for the industry. Debt to equity is 177 versus 55, and that worries me right there with that high debt because I do remember home builders getting overbuilt and over leveraged years ago. Could happen again. Return on equity is 13 versus 7.2. Net profit margin checks in at 3.5 versus 2.2. And then we have receivable turnover 116 versus 3.9. And then inventory turnover 1.2 versus 27. Chase, what do you got for the earnings going forward?
So current price here for Beazer Homes, $19.39. 52-week high here, $26.12. And 52-week low out, $9.08. Now I go out to September 2022. I see estimated earnings per share of $3.38. That would give us a nice target sell price of $56.11. Wow. So I mean that is a very good value there. But I will point out it is a smaller company, just a $600, not a $600, wow, that'd be tiny, $600 million market cap.
That's small. Yeah.
And there's only two analysts that have a target on it. So that is a little bit concerning. You're kind of on your own with this business, and the high debt would scare me away from it there, Jim.
All right.
Yeah.
All right.
And then, Jim, and the home builder that we did have in the portfolio, we had it because it was nationwide because of the fact we wanted to be part of that. But the home builders now, they do kind of scare us a little bit because we do see interest rates rising. We do believe that the market is very frothy, I'll say, across the country. And usually you don't make money when you buy things high. And this could hurt the home builders where perhaps, the other thing I want to look at, they probably don't have a large inventory, but they could have like houses being built. If the market turns, they get hurt because they have those and can't sell them. They got that debt looming over them. So I'd be very careful on the home builder, especially this home builder. Yeah.
All right.
All right, Jim?
Good enough. Thanks for the information.
All right, Jim. Thanks for calling. Have a good one.
You too. Thanks, guys. Bye-bye.
Bye-bye. All right, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's head out to Coronado and speak with John. John, you're in the Smart Vegetable Brent Chase. How can we help you?
Yeah, hi, guys. The stock I'm looking at is Chubb. Since you were on the insurance segment for a while there.
Yeah. I was glad to kind of see that. And Chubb, I think they also do health insurance. Is that correct?
Yeah, they do.
Maybe they do life. Chubb Life,
I've never looked at them as far as a healthcare provider, though.
Okay.
Healthcare insurance.
Yeah, I know the name. I just can't remember what they.
Property and casualty is kind of the main sector.
Okay. Well, let's take it to Chubb Limited, symbol is CB. Okay start, PE ratio 13.2 versus 12.7. Price to sales 1.9 versus 1.2. Price to book value 1.9 versus 1.5. And then price of cash flow checks in at 12.4. And that is more expensive than the industry at 8.4. We do say they pay a 2% dividend using 25% of the earnings to pay that out. Sales are up 12.4% year over year. That's above the industry at 8. Earnings per share climbed by 54%, which is very good, but the industry was up 227%. They are financial companies, so no current ratio. Debt to equity looking good, 25.7 versus 37. Return on equity is 10. That's about the same as the industry at 10.4. Net profit margin for Chubb checks in at 14.6, and that's better than the industry at 9.4. And no receivable or inventory turnover. Chase, earnings going forward?
Well, I did pull out this company exactly kind of what they do, and they have a lot of different insurance. I mean, they have workers' comp, they have health insurance like we talked about, they have commercial property, they do have the automobile, your traditional kind of property and casualty line. So they're pretty well diversified in terms of what they offer in insurance. The other thing they offer too is cyber insurance, which is
cyber insurance.
Yeah, which I think is obviously a growing need
Yeah.
after what happened earlier this year with the Colonial Pipeline. I know there was a healthcare provider here in San Diego that got hacked as well. So it's could be a good future line for them as that continues to be a need. I'm curious how much it makes up for the business. With that said, let's look at the numbers for Chubb. Current price here, $162.29. 52-week high is $179.01, and 52-week low, that's $111.93. I go out to December 2022. I see estimated earnings per share of $12.75. Would give us a target sell price of $211.65. So I think it's interesting here, John. I think it could be a good one.
And I think this is one that's kind of almost like one of these foundation type companies. And again, I like that they're getting into the hacking insurance, cyber insurance, and so forth, because of the fact that is, I think, growing a big concern. So I like it, John. I think it's worthwhile. Chase, can you put that on your notes for Monday? Doesn't mean we're going to buy it, but it means we're going to look at it.
No, I've always liked that the insurance business, those recurring revenues, and once people buy from an insurance company, they tend to stick with it for the long haul. So it's always been a good, stable, and profitable business.
And Chase, too, I think you said that they're into workers' comp as well.
Yeah.
Well, with a growing workforce, they should do well there as well also.
Yeah.
So, yes, good things for this one, John. So, yeah, we like it.
All right.
All righty?
Super. Thanks.
Thanks, John. Bye-bye.
I will say one thing that's interesting about insurance companies
Mm-hmm.
is there's going to be more automobile accidents this year than last year just because
Oh,
people
yeah?
weren't driving. I think people forgot how to drive. When I was driving downtown yesterday, I think there was 6 accidents on like the 15 and 163. I saw on my app, and I was like, "Oh my gosh, it's terrible!" Like it was
Yeah.
crazy.
And actually, I saw one yesterday coming home from work. I stopped off, got gas, was on Pomerado Road, backed up because of construction. First time ever, I saw a Tesla in an accident. Sorry, but it did not do well.
Really?
Well, because there's no, like in the front, it was just like smashed in dramatically. And I think they're supposed to be very safe.
Yeah.
And this was observation, but the other car didn't look as bad. But the Tesla was just kind of like the front end was almost gone. It's pretty bad. Yeah. So, all right. Phone number is 866-577-2473. Again, that's 866-577-2473. Let's go out to San Diego and speak with Jairus. Jairus, you're on the Smart Investor, Brent Chase. How can we help you?
Hey, good morning, guys. Actually, I'm going to slow down so you guys can keep up with me.
Can you go a little bit slower, Jairus?
Okay. So wonderful program. This is what I've learned so far. I've learned how to vote. I've learned what team to cheer for, and what store to buy jewelry at a good price.
There we go.
And to ride in cars and not rockets, and to buy insurance. How am I doing?
You're doing great. And, Jairus, that's why I still love doing this after 42 years of getting up, because investing is so exciting because you touch so many different things. You just pointed out why. And that's why we love what we do, because we're not just buying mutual funds or something else. We invest in companies, and you can understand those businesses. And as you can tell, we cover many different topics because it's exciting. Yeah. So
it is. I actually really enjoy you guys. But one thing you haven't covered yet, and that's why I'm calling about Vista Outdoors, VSTO, and just see what you think, what the numbers are. I got in a little bit ago and up about 33%. Just want to know what you guys think.
All right. Well, let's take a look at Vista Outdoor Incorporated. Their symbol is VSTO. Great start here, Jairus. The P/E ratio is 10.2 versus 1,111 for the industry. Price to sales, 1.2 versus 2.1. Price to book value, 7.7 versus not material for the industry. Then price to cash flow, 7.9 versus 60 for the industry. So great start here with the evaluation ratios. We do see sales were up 26.8% year over year, while the industry was down 2.2. Earnings per share for Vista climbed by 265. Industry was down 97. The balance sheet looking pretty good here. Current ratio 2.9 versus 1.4. That's positive. Debt to equity 67 versus 132. Return on equity, 45 versus 0.5. Net profit margin checks in at 12 versus 0.19. And inventory turnover is 4.1 versus 2.3. And receivable turnover 7.2 versus 4.4. I cannot remember when every single ratio that we looked at was better than the industry average. This one hit that. Very curious on what the earnings are going forward.
And, I haven't even had much time to look at the numbers yet. I was just trying to find out what this company does. But, obviously it's an outdoor company.
Right.
But I think probably the most recognizable brand I see here is Camelback. So they do own Camelback, the
water thing, yeah.
When you go like hiking and stuff. They also do have some like shooting sports as well. So I'm guessing looks like Remington is one of their brands. Federal is another one of their brands.
Do they own Remington, the gun company?
That's what appears.
Okay.
Yeah. And then also Bell helmets. I was like, Bell, why does that sound so familiar? I remember going to Target the other week, and they have like the bicycle helmets and stuff. So it's an interesting company here. I'm curious. They have a lot of different brands. I'm curious what the breakdown is for each brand. They also have golf in there too. So.
Wow.
I'd want to understand a little bit more again about their different segments and how profitable they are. And sometimes companies get too diversified where they're not really doing well, and they need to kind of trim the fat, so to speak, in some areas.
Or they don't understand what they got into.
Yeah. So something to look at it just a little bit closer, but I like the company so far in terms of what they do. Current price, though, for Vista Outdoor, $45.18. 52-week high is $47.62. And 52-week low, well, that's $13.29. Now, I got to March 2023. I do see estimated earnings per share of $3.71. Would give us a target sell price of $61.59. So it's intriguing here.
I mean, I'm impressed with this company. And again, you know what I'm going to tell you, right?
I already reached for my phone.
Yeah, put it in your notes for Monday because I can't remember. And we're not going to go ahead and buy this on Monday, obviously. But I like what we're seeing on this business in this difficult time when everything's overpriced. And also, too, I'm thinking we are the start of summer. We do have people now cooped in their homes for a year. They want to get out. This one could be the right company at the right time.
And the other big thing, too, we talked about Macy's and are concerned of them kind of being the distributor of different products and people having to go there. So like the middleman is they own the brands. We like companies when they are the brand because even if you get rid of, I'm not going to say this is happening, but you get rid of Amazon, you get rid of the storefronts. Well, you can still go online and you still need to buy these companies. So there's not really a big risk there.
Yeah. So Jairus, a great pick there. What are you doing next Saturday? We'll have you come on the show and give us some more.
Listen, I've been listening carefully to you guys, and I listen to things and tap into things that I didn't used to before. And I actually got this stock pick from watching somebody on YouTube going outdoors that they didn't do before. They did it last year, and they really enjoyed it. And they just named this store that they go to and really liked it. So I looked into it and thought it'd be something to get into, and appreciate the analysis. And I just love calling you guys and just learning every Saturday. So thank you.
You're welcome. Jairus, what we want you to do, because now, and I think this is going to be like a long-term hold company. It's a good business. What you want to do now is like each quarter, you want to read, what's going on with the company, how they do for the last quarter, what new products they have coming out. Listen to the executives, read the conference call, because this is a good business. I think is one that's what we do when we invest, and that to me is part of the fun is doing that, and it really keeps you on track because you're at a great start here. Continue on, and I see they're a fiscal year, so they're the next. Well, they still report on a quarterly basis, but it's fiscal year. So.
Yeah, and I think this one might have been affected by who's living at Pennsylvania Avenue right now. So that was another part that got me interested in this stock. But I like the diversity of products they own. So I appreciate the tip. I definitely will look into what the leadership is doing and what the heartbeat of the company is, and maybe add some more to the holdings.
All right, sounds good. Thanks for calling, Jairus. Have a great weekend.
You too.
Bye-bye. Chase, I got to say, that sums up why when people say, well, Brent, when are you going to retire? I don't know, 2045. It's because this never gets boring, because when you do it the way we do it, of getting into the businesses and understand the business and researching them, you own something. And I've been doing this for 42 years. This is still exciting to me. I still get excited, doing the show for 28 years. I still get excited. Like, what are we going to get calls today? I know Jairus might call in for us, but I get excited doing this. And that's what I think a lot of people miss out by trying to watch the market and watch the prices. You're missing the excitement of true investing.
Yeah, it's such a great point. We had clients come into the office yesterday, and we were talking about kind of what's going on with the portfolio, and we were going through the companies and talking about what's going on with our businesses. It's a lot different than just saying, well, just stick with it. You just got to stay the course. It's great mutual funds. Well, what's in those mutual funds? Yeah, it's a lot better to kind of have that understanding, and it makes you a lot less emotional with those companies because, like we just talked with Josh about the Vista Outdoors. I don't think Camelback's going anywhere. People are still going to go hiking, and they still need to drink water.
Right.
It's a lot more efficient to have one of those than carrying around a water bottle with you. So, I think it does really help with the emotional side of it, as I said.
Yeah. To own something makes a big difference. All righty. Phone number is 866-577-2473. That's 866-577-2473. Let's go out to Jacob in Alpine. Jacob, you're on the Smart Invest Show. Brent Chase, how can we help you out?
Hey guys, thanks for taking my call.
Sure.
I'm kind of new to the whole investing thing, and it was actually my wife that was kind of the catalyst to get into it. She had some friends that were kind of getting into it at the same time, and it kind of started with this company, Metamaterial, and it's kind of apparently a newer company, and it's kind of one of those ground-up stocks. But I've been reading a lot of things on how it's doing this merger with another company, and there's some type of reverse split going on, and I'm so new at this, I don't really understand it. So I've been listening to the show, trying to just glean from information. It's amazing what you can learn just by hearing what you guys, how you guys break down these stocks. I'm taking notes.
Yeah, and Jacob, I'm having a hard time pulling anything up. Jace, you get anything on this company? I think it might be a very small company. Jacob, do you know what the market cap or what the stock trades at here for this company? Did you find that?
Well, so its ticker thing is MMATF.
Oh, okay. I had MM. Okay, so let me see.
No, MM.
MM. Yeah, Mary Alpha Tango Foxtrot.
Yeah,
Okay.
There's not a lot of data on it. I do have some information.
Okay, I'll let you go, Chase. I got nothing over here.
Yeah, and as you kind of said there, Jacob, it is a newer company. It looks like it came around March of last year's when it looks like it did start trading. And current price here, $13.95. I mean, I look at the 52-week low, 19 cents.
Wow.
I mean, that's crazy how much it's appreciated. 52-week high is $14.98. Now, the current market cap with the appreciation is about $1.5 billion. So it's a decent-sized company.
I'm surprised on that, yeah.
I mean, it was trading at 19 cents, though. I mean, it was a fraction of that. It was in the millions. So it is interesting that there's still not much data on it. I can't find any analysis or, analysts that are giving, like, target sell prices, target earnings. So I can't derive anything from it. And, this thing, it's done really well. It looks like a communication equipment is what they actually do provide. I'm not sure exactly what they do, but I just get scared when I don't have good data. And if I don't have analysts following it, you're on your own with this one. And, there's a lot of great companies out there that you're not on your own, where I'd rather invest in one of those.
And Jacob, one thing you can do is go to the company's website. They'll have the financial statements there. Because what you want to find out, are they have too much debt? Do they have earnings? Do they have sales? I mean, you want to find all this stuff out. And because there's a lot of speculation going on with companies like this, and that's okay to do if that's what you and your wife understand you're doing, but it is different than investing. So this one here, I got to put definitely in the speculative category, and it can go. What was the price now, Chase? You said like $1.95 or something.
No, it's now $13.95.
Oh, $13.95. Okay,
yeah,
so
it's gone up.
It's gone up dramatically.
Yeah.
And what the company does, because maybe it's with cryptocurrencies or something that just really has brought it up dramatically.
Communication equipment.
Okay, so that's
weird.
Yeah, it's just very. And Jacob, when we have questions about something, we don't buy it. If we can't get the right answers to those questions, we don't buy it. So what you want to do on this company here, and you got to realize it could go to 27, it could go to 30, $50 a share, but if you don't understand what the company is doing, you're just playing the lottery, So and that's what you have to do. And when people play the lottery, I hope they win, but you want to realize that you want to be careful here, because what I don't like is that people do something like this, and then they lose money. They say, "Oh, stock market's risky." Well, it's not risky if you know what you're doing. So just kind of understand that. I wish we could help you more, but I'll just point you to the company's website, try to find out more about what the company does and what their financial statements look like.
Yeah, and just no data. That's a concern right off the bat. I like to look at data, analyze the data, and if there's no data to analyze, it's a concern.
Yeah, and we did point out some good companies today. So,
so
you can look at those as well. All right, Jacob?
All right, thank you so much, guys.
All right, thanks for calling. Have a good one. Bye-bye.
You too.
All right, that opens the phone line, 866-577-2473. Let's go back out to San Diego and speak with Jill. Jill, you're on the Smart Invest Show. Brent Chase, how can we help you?
I'm 70 years old, and I'm interested in stocks that have good dividends, and I bought a few companies that have really great dividends. They're on the dividend aristocrat list and all, but I'm kind of interested in IBM because they have an outstanding dividend, but is it worth the price, or should I wait for a pullback in the market to buy them because they've had their issues? But I don't know. I'm really torn about it.
Well, let's take a look at that. And Jill, I want to look at IBM because IBM has struggled, I'm going to say, for the last 5 or 6 years. And they've had a great dividend, but they just, even Warren Buffett held it, I think, for years. And he sold it at I think, a small loss, if I remember correctly. So that's one thing, too. When you get dividends, it's great to get the higher yield on the dividend, but you want the principal to grow as well, or at least not decline, because then that kind of defeats the purpose. So let's take a closer look at IBM. Actually, it's called International Business Machines. Everybody calls it IBM, and that is their symbol. Not a bad start here, Jill, because the PE ratio is 24.8 versus 64. Price of sales looks good, 1.8 versus 4. Price to book value, not material, and that's the same as the industry. And what that means, if you take away all the intangible assets, there's no value to this company when you take away the liability. So you don't like that in a company. We do see that the price of cash flow is 10.8 versus 22.3. So that is good. You do get a 4.5% dividend. Very attractive. However, they're using 110% of their earnings to pay that out. Now, we do know that last year we had COVID, so things slowed down somewhat. But again, 110% payout ratio that cannot be sustained unless their earnings grow dramatically. We do see year over year the revenue is down 3.6%. Industry is up 4.4%. Earnings per share year over year last 12 months for IBM was a negative 42.9%, but yet the industry they compete in was a positive 8.4%. Look at the balance sheet. You got a current ratio of 0.9 versus 1.3. That's okay. What is not okay is a debt to equity is 263 versus 72. And keep in mind that equity or intangible assets, which could be written down, which could actually increase your debt to equity and make the balance sheet even weaker. We do see they have a return on equity of 25.4 versus 12.8. That is good. Net profit margin 7.1 versus 6.3. And then receivable turnover is 10.6 versus 4.8. And then inventory turnover 20.9 versus 19.5. Chase, what do you got for the earnings?
Yeah, so current price here for IBM, $146.84. 52-week high, well, that's $152.84. And 52-week low, $105.92. I looked at a longer-term chart of IBM, and it just seems like, actually, doesn't seem like it has occurred, that IBM just hasn't gone anywhere, really, for the last 10 years. It did go up, let's see, it looks like it peaked around about 210, 215, somewhere around there. And then it's just kind of traded around $100, $150 a share.
Where's it at now, you said?
Current price is $146.84. So looking, though, at the 52-week high, it's $152.84. 52-week lows, $105.92. I do think it is interesting, though. We talked about how COVID occurred, and that might be a problem for the dividend payout ratio. A lot of technology companies thrived during COVID.
Yeah.
What was going on with IBM? And I don't know exactly all of their business segments, so I can't tell you the exact reason that they had problems, but it just seems strange that they did kind of struggle a little bit more than other tech companies.
Yeah, and I think IBM was always like the big company computer, so to speak. Yeah. And as you know, people have been going home to do that, more of the personal computers. I think IBM owns Lenovo, which is your smaller laptops and so forth. But Jill, I mean, you mentioned that you're 70 years young.
I haven't given a target sell price on it yet.
Oh, I'm sorry. I thought you were done. I'm sorry. Okay. Hold on here.
Yeah,
okay.
To give you a target sell price on IBM, I mean, I go out to December 2022. Estimated earnings per share, $12.05. Would give us a target sell price of $200.03. So valuation, it's been the problem for us for, I'm going to say, the last 6-7 years.
Yep.
Is IBM, the valuation has always been there, but the balance sheet has been a hold up. And also, too, just the business transformation. I know they got a newer CEO in there.
Yeah.
What is going on with kind of the cloud? I think that was the whole reason he was brought in, was to do that. I think they bought some company too, like Red Cloud, or I forget the exact name of it, but that was supposed to be a transformative acquisition. I'm not sure how that panned out.
Right.
It seems like not great if the stock hasn't done much.
Yeah, hasn't done much. And Jill, as I said, you're 70 years young, which concerns me in a company like IBM, because I'd hate to see you buy IBM for a 4.5% dividend. Sounds pretty attractive, but then 5-10 years down the road, the stock went from 140 down to 90, perhaps worse, and it got all that debt on the sidelines that's sitting there. It just is not what I would call a safe company. I mean, we do income portfolios for our clients, and this is not one I would put into the portfolio for our income clients.
And the other thing that worries me too.
Sounds like there's more bad news than good.
Yeah,
Right.
yeah. And I was going to say the other thing that worries me too, Jill, is the dividend yield. I mean, if that's the reason you want to buy it, I do worry about that payout ratio. And if they can't get their earnings growing, that dividend payout ratio is going to struggle, which means they can't invest as much into the business, which means they're not going to grow the business, and then they might have to cut that dividend. So then you lose the whole reason you invested into it. So, as you said, I think there's more bad than good to IBM at this time.
And I know you mentioned the dividend aristocrats. You have to be careful with that because that's all they kind of focus on. So it's kind of like the start of your research, and then like you did here, you said, well, gee, 4.5% IBM. Let me look closer at the fundamentals. But I know some people just buy, well, I was on dividend aristocrats, so I'm going to buy it. I think it's a mistake many times. So, all righty, Joe?
I'm looking at boring old companies, boring old blue chips. But
well, they can be good, but you got to find the right ones.
Thank you so much for your help.
You're welcome. Bye-bye.
Bye-bye.
All right, let's head out to Alpine and speak with Jim. Jim, you're on the Smart Best Show, Brent Chase. How can we help you?
Hey, good morning, guys. Things are going well here in San Diego this morning for all of us, I think.
Yes, I think it's a great day in San Diego.
Yeah, I finally got Jacob out of the phone booth out here in Alpine. So and a question in the stock that you were reviewing for him. You said it was at 19 cents at one point.
Yeah.
And I thought stocks got delisted if they went under $1.
They can get delisted, and that's the strange thing is it could have done something with share splits where it could have been really listed at $1 or $2 or something, and they kind of changed the stock, and now if you look back, it's on a share adjusted basis of 19 cents. So I'm not sure. I mean, as I said, there wasn't much information on that company. So
it could have been over the counter.
Yeah.
I have some actual information super quick. Torchlight Energy, which has the symbol TRCH, it's going to go to a 1-for-2 reverse stock split with Metamaterial, which is the company we just talked about, on June 28th. And it's going to become a new company called Metamaterials with a space in between the name. And it's going to have a new ticker symbol then at MMAT. So just a heads up on that, too.
Okay. Thank you, Brent.
Yeah, and it could have traded. I was going to say it could have traded over the counter as well, as you said. So it's interesting, yeah.
What was that, Jim?
Did he mean to say 1 for 2? A reverse split would be 2 for 1. He said 1 for 2.
Did he say 1 for 2? Yeah, because when he said reverse split, I knew what it was. Yeah, so it's a reverse split, you said.
It's saying 1 for 2 online. That's what it's saying.
But it's saying 1 for 2.
This is from Seeking Alpha. That's the name of the company.
Which we like. So reverse split, 1 for 2. Okay, all right. Well, let's move on.
Yeah, it's a company we never buy.
We wouldn't buy it, that's right. We got the information out. Okay. How can we help you, Jim? Yeah, I don't want your phone booth to get closed on you.
So Carnival Cruise was a good company before the pandemic, and you guys have reviewed it once or twice in the past about forward bookings and stuff like that. And I bought some leaps in it back when it was really tanking, and they don't come due for another 6-8 months, and I'm just wondering what your prognostication is on Carnival Cruise Lines.
All right. Well, let's go with the numbers of Carnival Cruise Line. Their symbol is CCL. Still no PE ratio, same as the industry for Carnival Cruise Lines, and obviously not making any earnings over the last 12 months. The price of sales for Carnival is very expensive, 37.4 versus 12.6. Price to book value, 1.8 versus not material. And also Carnival has no cash flow at this time. We do say they did not pay a dividend. They used to pay a nice dividend. They cut that, obviously. Their sales, no surprise, down 96% year over year. Industry down 71. Earnings per share fell by 617. Industry down 1,449. The balance sheet used to be pretty good. It is no longer a good balance sheet. We have a current ratio of 1.5 versus 1.4. That is okay. But debt to equity is now 158. Not as bad as the industry at 498, but I really get concerned with a debt to equity much over 120. We do see return on equity a negative 51.8 versus 86. Net profit margin, wow, a negative 1,375 versus negative 55. We do see receivable turnover is 2.1 versus 4.9, and then inventory turnover is 6.9 versus 11.6. Chase?
I was going to ask real quick there, Jim. Your leaps, are they to protect you, to sell it, or to buy it?
They're calls. And
Okay.
I wanted to ensure the lower price that it was selling at last year.
Okay, cool.
And the leaps are up. They're up in value.
Yeah.
Nicely up.
Yeah.
And so I'm just going, should I sell it or get rid of the keep them to exercise?
Yeah. So, well, let's look at the numbers here to see kind of what you should do with those options. Current price on Carnival Cruise Lines, $28.13. 52-week high is $31.52, and 52-week low, $12.11. If I go out to November 2022, I see estimated earnings per share of just 33 cents. That would give us a target sell price of $5.48. And of course, this is going to be a little bit skewed because they're kind of having to revamp the whole cruise industry. So it's a complicated one. And the thing that concerns me the most about these cruise companies is they just had to absolutely destroy the balance sheets and the kind of financial capital of the companies to survive. So, it was interesting last year. We didn't foresee the pandemic lasting as long as it did, and it kind of derailed our investment thesis into Carnival and cruise lines being an interesting sector. So I personally think that I would sell the leaps if you've done well on them, because I wouldn't want to buy the stock anyways.
What was the target sell price yet again, Chase?
$5.48.
Oh, so nowhere near the 28 it currently is. And that's the thing. I think a lot of people are getting in like, oh, the cruises are coming back, or let's invest in these companies. Well, I think that's going to help the cruise line and Carnival Cruise Lines for a while. But once the true investors get in saying, well, wait a minute, this debt is terrible.
And I think they issued a ton of shares, too.
Oh, they issued more shares. Yeah, exactly. And they're just not making the profits. They got the boats filled, but it's not profitable. So that concerns me. And I hope they turn around, but I would not have my money in this, either by the stock or by a leap, because I think there could be problems going on.
And the other thing, too, that I'm curious on is they have a lot of, I believe, outstanding liabilities from the people that bought cruises last year and in 2019 that still need to cruise. So those aren't going to be cash flows coming in. They're actually liabilities where they have to serve those people their tickets and go on cruises. So I'm not sure how their cash flow is going to look this year or next year, and that's why I think the earnings are still so depressed. But, things might turn around in 2023. But I think there's just a lot of kind of hype building behind these travel companies.
Yeah. And the hype could take the stock and the leaps higher, but I just think you're playing a gambling game right now, and I would take my profits and buy something stronger. All right, Jim?
Or they sail away.
Oh, we don't want them to sink.
I don't know, Chase. Keep that day job, Chase.
And Jim,
there you go.
Thank you for calling. Have a good one.
You guys, thanks a bunch.
Bye. Yeah, it's so difficult because we did own Carnival Cruise Line before all this craziness happened. It was a great business. Never had a losing year for 40, 50 years. And this shutdown of COVID just destroyed a great business.
And it's interesting, too. I mean, just speaking of travel and even the airlines, it's like the airlines and the cruise lines, I think, have gone way too far. And just looking at the current prices without factoring in all the financial, I'm going to say engineering, with issuing the stocks. Yeah. And it's just, I think people are looking at the reopening trade rather than the fundamentals.
Exactly. Well, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. Or visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information on investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Today's show is sponsored in part by Thomson Reuters Refinitiv. Closing song, Frank Sinatra's My Way, is performed by local entertainer Roman Palacios. Have a great day. Thanks for listening to the Smart Investing Show.
And may I say, not in a
This program is sponsored by Wilsey Asset Management.